Okay, students, Assalamu alaikum. This is your SBR trainer, Mustafa Mirchawala. And today we are going to discuss the first session of our revision days. And the objective of this session is to remove fear among students, because SBR paper is always a practical paper. In the last time, I also make a short video of 8 minutes. I'll send you guys for exam techniques. So majority examiners, majority tutors, they all say this thing, that you always get new things in SBR. Like in practical life, you go for job and every day you find a new thing. So please don't expect the same things which already came in the past paper or in the exam kit that it will be reproduced. But yes, luckily few things are repeated, but still get ready for new questions. So you just need to write your suggested solution. And if you think, can you guys hear? Yes, the voice is perfect. Okay, the voice is perfect. And if you think it's difficult, so it's natural, it's difficult for everybody. Even when I was a student, this paper was difficult for me as well. And believe me, I can quote the wordings of position holders, guys. Even when they give their paper, they are not sure about the passing of this exam, and in the end eventually they got position. So yes, difficulty is there, and it's natural, right? Okay, so just you need to your first objective is to solve 100 marks, and you need to give answers in your own words, what we call it suggested solution. Whatever you feel right, just write it. That's it. Don't worry about it, right? One more thing, I have my admin staff has sent a WhatsApp group link in the chat box. So I would recommend all of you to join that chat box so that I can send you the articles. I can send you the articles and all exam help, and plus this next class routine, everything we'll communicate through WhatsApp. Okay, so it's better you guys join the WhatsApp group. We have sent you the link of WhatsApp group, so kindly join the WhatsApp group. Okay, right? And now we are going to start the latest past paper available on the net, that is March June 2021. March June 2021. We are sending you the link. Don't worry, we are sending you the link. Wait. Yes, it's there. So I again repeat, the objective of today's session is to reduce the fear. Okay, right? Because people think it's very difficult. We'll try to solve the very latest paper, I would say it's very latest fashion in front of you. Okay, right? So now let's start. It's March June 2021. Now we are starting with the first question, and normally you all know in the first question you get consolidation, but you will see that consolidation is not complete 25 marks. It's like 15, 16 marks. Okay, so if somebody is weak in consolidation, don't worry, it's just 15% of your paper. It's just 15%. Think like that. Okay, right? Your objective is to score 50 marks. That's your first priority. Okay, one more thing I would like to say, as you all know, for our registered students, we have introduced marking facility. You can send us your PDF of your question of your solutions, of your past paper solutions, and we'll mark and we'll give you individual feedback for that. Even we have started giving feedbacks to many students, and many students are using this service. Okay, so those who are registered students, they are most welcome. They should send so that they can, before exams, they come to know their mistakes. Okay, one more thing I would like to guide you, that right now this is the time. Don't watch routine classes now. Don't watch routine classes. These are ending days. Better you read the articles from accaglobal.com, the technical articles of SBR. Better you read the summaries. Better you solve past papers. Yes, past papers. And try to get it checked with your teacher. Okay. And in the last 2 or 3 days or last 4 days, better solve the mock exams. Mock exams, like try to practice with timer in exam condition. Try to solve the full paper. Okay, right? Or in the accaglobal.com, you will have complete papers as well. Now, the first question, the name of the first question, I hope you can see the screens are clear. The name of the question is Columbia. Columbia company is a parent of a listed group which operates within the telecommunications industry, right? During the year ended 31st December X5, yes, important information. Always keep the year end in your mind. The 31st December X5, Columbia company acquired a new subsidiary and made adjustments to its pension scheme. So the question revolves around two things. Simple. The first thing is acquisition, that is consolidation accounting. And the second thing is pension scheme, means IAS 19 employee benefit. IAS 19 employee benefit. Okay. The group current year end is 31st December X5. Now, the name of the subsidiary is Peru. Acquisition of Peru. Brazil is a competitor. Brazil is a competitor of Columbia company. Now listen, at one side we are Colombia and we have a competitor named Brazil, two people, or you can say two investors are there, two investors, Colombia and Brazil, right? And the investee, or we call it subsidiary, is Peru. On 1st of July X5, see this date, 1st July X5, both Brazil company and Colombia company acquired 50% of the 5 million ordinary shares or $1 of Peru. Please look at the screen very carefully. Don't use cell phones and all these stuff, please, now, just for this class. That means both entities acquired 50% shares of 5 million shares of Peru. Now listen. That means subsidiary company issued total 5 million shares, and out of 5 million shares, 22.5 million shares are acquired by Brazil and 2.5 million shares acquired by Colombia. So apparently, just listen, apparently it looks like it's a joint venture. It's a joint venture, right? Okay. But still, for joint venture, we must prove the joint control thing. So let's see what the story tells you, right? Now, I will in the next paragraph is all about IFRS 10. This paragraph and the next paragraph is all about IFRS 10. Very interesting, very interesting, and you will like it. Okay. Now, the consideration paid by first at one end Colombia is there and the other end Brazil is there. The consideration paid by Colombia company consisted of cash of $8 per share. Now pause. All of you take out your calculator. Now you guys are no more kids. Please don't act like a kid. You are at the end of your exam. Now you should give proper response. Total 5 million shares Peru has issued. Out of 5 million, 50% shares are acquired by Colombia. So 50% of 5 million is 2.5 million, or in easy words, we call it 2,500 shares. Okay. And so we acquired 2,500 shares. And how much are we paying in terms of cash? It's $8. So 2.5 million, call it 2.5 million. 2.5 times 2.5 2.5 times $8. 2.5 million times $8 will give you 20 million, right? Okay. So your cash consideration is 20 million. Simple. 2.5 million times $8 per share. It's 20 million. This work you do at F7 level, basic level. So don't worry about it. Go relax. Now, also one more thing, and also a 1 for 20, for every 20 shares, 1 shares. For every 20 shares, we are issuing 1 shares. Also a 1 for 20 share exchange when the market price of Colombia's company shares was $10, important data, $10 per share each. Now go slow, pause. For every 20 shares, for every 20 shares, we are issuing for every 20 shares, we are issuing how much? We are issuing 1 shares to them. For every 20 shares we are receiving, in return, we are giving 1 shares. So the fraction becomes 1 upon 20. Fraction becomes 1 upon 20. Listen. So we have, in total, we have received their 2.5 million shares. In total, we have received their 2.5 million shares. So just think, how much are we returning? 2.5 into 1 upon 20. 1 upon 20. So just do it. These are the number of shares which we are giving. 2.5 million multiplied by 1 upon 20. These are the number of shares which we are giving as a consideration. Or sometimes when I teach kids, baby level students, I say, these are the number of chocolates we are giving. These are the number of chocolates we are giving. These are the number of chocolates we are giving to the subsidiary companies' existing shareholders. Now tell me, what is the cost of 1 chocolate? What is the price of 1 chocolate? It's $10. The price of 1 chocolate is $10. So in simple terms, wait, 2.5 into 1 upon 20 multiplied by $10. What's the price? Can you tell me? 2.5 into 1 upon 20 multiplied by $10. How much is this? It's 1.25. Thank you. So can you just simply calculate this total consideration from Colombia? It's 20 plus 1.25, 21.25. 20 plus 1.25 is 21.25. Now let's start gathering the evidence. There were 2 people at one side. We are Colombia. This is Brazil. Okay. And in between, Peru. We have also 50% shares. Brazil also has 50% shares. Okay. And now we have just calculated, the price which we just paid. Colombia paid how much? 21.25. Colombia paid how much? 21.25. Now, let's see. Now from here, it's Brazil. Brazil company also paid $8 per share for their interest, but did not issue any shares to the original shareholders of Peru. Excellent, excellent, excellent. That means whatever cash we paid, we Colombia, we means Colombia, whatever cash Colombia paid, the same cash is paid by Brazil. So how much was the cash consideration? It's 20 million. How much was the cash consideration? It's 20 million. But Brazil did not give any shares consideration. So now be active and think over it. Come on, quick. That means from Colombia side, how much COI is paid? From it's 21.25. And from Brazil side, it's 20 million. It's 20 million. Now, first evidence. Colombia is paying 21.25 and Brazil is just paying 20 million. So definitely whoever pays more will get more. This is the rule of this world. Whoever pays more, get more things. That means this is the first hint that Colombia has paid control premium. Colombia has paid control premium. That means Colombia is acquirer. Colombia is the parent company because Colombia paid something extra, because definitely they will be getting something extra. It's like something for something. So this is the first evidence we gathered that Colombia is the parent company because Colombia paying more consideration to Peru, right? So he will get Colombia will get some extra rights. Okay. So this is your first evidence. Now please be active, don't sleep. The next thing, following the acquisition, the ordinary shares of Peru have 1 voting rights each. Okay, so these are normal ordinary shares. So apparently, if we see 50%, COI means cost of investment. Somebody's asking. COI stands for cost of investment, please. Now, the ordinary shares of Peru have one voting rights each. So now it looks like both companies has 50% shares, so same voting rights. So apparently at in the beginning it looks like it's a joint venture, but that's not the reality, because we have gathered one evidence. Okay, now the second evidence. Following the acquisition, Colombia company had the contractual right to appoint 60% of the board of Peru company, with remaining 40% appointed by Brazil company. Excellent evidence, big evidence. That means in the board, 60% people will sit from Colombia side, and only 40% from the Brazil side. So you know this thing, that in IFRS 10 in your exam kit, these questions are there. In my lectures, in normal, everywhere you have studied, the party who has the biggest representation in the board is parent company. So again, this point is going towards Colombia, right? Easy point. No issues. Go slow. Now, Brazil company has a veto rights over any amendments to the articles of the incorporation, and also over the appointment of auditors. Now, appointment of auditor is not a substantial thing. Appointment of auditor is a secondary type of thing. So if you have veto for this appointment of auditor, that means you are not the king. Okay. And one more thing, I hope you remember these two words, substantial rights. There are two words. And one is protective rights. Now listen carefully. Listen. Veto means, somebody is asking the meaning of veto. Veto means Brazil can undo. If there are amendments, Brazil can undo, cancel it. Now, protective rights are like, have you heard about the bank loans? When a bank gives loan to company, so bank keeps some security. Like bank, you might have heard about the charges, fixed charge. So bank take charges of certain assets. So if you don't pay the loan or interest on time, then bank can sell your assets. So these are protective rights, just for the protection of bank. It doesn't mean bank is the owner. It doesn't mean bank has control of the business. Okay, so these are just protective rights. But substantial rights are different. Substantial right means you have given all the rights of financing and operating policies of an entity, major rights of major decision making rights, then it's going to be substantive rights. So the Brazil company appointment of auditors and these are not substantive rights. So again, this point also indicates that Brazil is not a parent company. One more thing I would like to say, and try to accept the reality as soon as possible. At SBR level, this professional level, you can't get exact close questions. The questions are little bit gray type, and you need to reply it politically. You know, like the members of political party. Have you ever seen them interviewing when they go to TV channels and they give interviews? So then they never give obvious answer. They never give a straightforward answer. So you need to prove things by gathering evidence. Okay, so don't expect 1 + 1 here. That's simple. Now, Brazil company and Colombia company each appointed one member of Peru's company's senior management team. See, both of them are appointing one member. It is the senior manager appointed by Colombia company who makes the key decisions regarding the development of Peru's new technologies, its principal revenue stream, the market that it will operate in, and how it is financed. That's it. That's the end. That means both have appointed one senior manager, but the real powers lies with the manager of Colombia. See all the relevant activities. In my lectures, I have also used this word relevant activities. All relevant activities are in the control of Colombia, or I should say the substantive rights are with Colombia. So majority points are going with Colombia, right? Okay. Then the senior manager appointed by Colombia also provides a supervisory role and has the right to request that the significant activities get board approval, such as imposing restrictions on Peru company from undertaking activities that would significantly increases credit risk, Okay, so this senior manager of Colombia is connected to board as well, and he has the right to make things done or control the risk profile of the company. So this part was linked to IFRS 10. So now we can say the majority points are going with Colombia. So yes, Colombia is the parent company, Colombia is the acquirer. Colombia is the parent company, Colombia is the acquirer. Okay, so now we need to check what is the requirement. Let me shift myself to requirement. Okay, and don't take tension, go very simple. This is the requirement. See, this is the requirement. Explain a draft and explanatory note. Now what does it mean? Wait. Draft and explanatory note, that means this point is for all three requirements are theory. You are not getting. Draft and explanatory note to the directors of Colombia. What is written? To address the following issues. That means all three issues are explanation. All three is explanation. Even if there is some practical work, do it, but explain it. If there is some practical work, again you need to explain. Even the IS 19, the 3-column work, you remember DBO plan asset thing. In that 3-column work, still you need to explain. And in examiner has written in the comments that those who just made the 3 columns, we didn't give any marks. That was not needed. That was the supportive work. The real work is explanation. See, explanatory note for all three of the. So it's all about theory. Right? Okay. Now, first A point, whether Colombia company should be considered the acquirer in the business combination with Peru. Yes, this is all about IFRS 10, whether Colombia is parent company or not. Okay, right? So I'm going to show you the model answer, and it's very simple. It's in very simple words you can write, or even you can write more simpler, because you will get a new question in the exam. Yes, parent company is called acquirer as well. We call parent company as acquirer. Now, please see, this is from the red. You can see in the screen from the red pen. The typing material is your requirement A. This is your requirement A. Okay. Simple go. As per IFRS 10, an acquirer is the entity which has assumed control over another entity. This guy is parent company. The parent company is the guy who controls the subsidiary, right? Okay. Now, I'm sure because I personally teach basic level F3, FA level accounting, then I teach FR level accounting, and I teach SBR level, and then ICW corporate reporting level as well. In all these levels, IFRS 10 control definition is there. IFRS 10 control definition is there. The 3 points. All students must remember these points. These are free marks. What is the definition of control? Power over investee, rights to or exposure of variable returns. Remember, and current ability to affect those returns through your involvement. These are the three simple points, and it is written. Investors, parent company, we call it investor, and subsidiary companies investee. Investor controls an investee where it has power over the investee. The first point, this is the first point. It has, see, this is the first point, then this is the second one, exposure or rights to variable returns from its involvement with the investee. And number third, this is the third point. This is the third point. The ability to use its power over the investee to affect the amount of investors' return. These three are the super hit points of control definition. You all must know, and I'm sure you guys already know this. You are just doing it fifth time, I think, because it is also available in my lectures, all exam kits, all past papers, everywhere it is there. Okay, so these are the cash marks which you needs to reproduce, or we should say this is the, you need to write some standard wordings. So this is your state the rule. Okay, now let's start connecting things. We need to consider the consideration. See the first point, we need to consider the consideration transferred for the relative share of ownership. It may seem that Colombia company and Brazil company have entered into joint venture arrangement. Now, apparently because the holding was 50-50, so a common man can say this is joint venture. A common man can say without knowing the real facts that this is a joint venture, but this is not the case. Now, since both entities have paid equal amount of $8 per share, and equally have obtained 50% of the equity interest with equal voting rights of 1 vote per share. So apparently it looks like it's a joint control. This was the first point, but it is not the case. I will prove it wrong. However, now see, however, the scenario does not indicate that unanimous consent. Hold. I'm sure this word is again not new for you, because in IFRS 11, you remember joint arrangement. To prove joint control, whenever you need to prove joint control, the parties must have this unanimous consent. That if, for example, there are 3 people in joint venture, there are 3 people in joint control, so there must be unanimous consent for all 3. If one of them say no, then we can't change anything. Okay, right? So unanimous consent is required because decision-making responsibilities appear to be split between Colombia company and Brazil company. Okay, so there is no such thing as unanimous consent. We have just read the question. Therefore, there is no joint control over the key operating and financing decisions. Secondly, we need to consider in who has the rights to appoint the majority of the governing body. Yes, majority of the party who has the power, to appoint majority of the directors. The party who has the power to appoint majority of the directors is basically parent company. So yes, Colombia has 60% in the board, right? Thus, Colombia has a shareholding of 60% in respect of the appointment of board members. Brazil has power to amend the articles of incorporation in the appointment of auditors. This is just the copy paste of the question. Okay, so this first point goes with the favor of which company? It's basically Colombia company, right? Then further we need to distinguish between substantive and protective rights. Major point, substantive and currently the rights seems to be more of protective, because they appear to prohibit changes in the activities of investee, which Brazil company does not agree with, rather than give Brazil company power, right? So he can only veto some changes. Brazil can only veto some changes. So it's like giving protection to him. It's like giving protection to Brazil. This is not substantive rights, because in the last lines of the question, we openly read, yes, the recording will be available, but it's better you attend the live class. In the last paragraph of this portion, we studied that the major substantial right lies with Colombia, Brazil has just the articles are just providing protection to Brazil. So they have just protective rights, and protective right does not means control, does not means control. Okay. Now, additionally, these are not rights which would allow Brazil company to affect the profitability of Peru company and subsequently their returns. Okay. So Brazil company cannot affect the return, the starting point, the variable returns. Brazil company cannot affect the variable return, cannot affect the variable return. Okay. Now, protective rights do not prevent Colombia from obtaining control. That means the control lies with Colombia. Now, next thing, also appointment of senior manager, the very valid point. Appointment of senior manager needs to be considered. Both entities have right to appoint one senior manager. However, rights of the senior management are appointed by Brazil, while key decisions made by senior managers are appointed by Colombia, right? So the major decision making like revenue streams, decisions of revenue streams, right? Okay, entering in new markets, so risk management, these all decision makings are in the hand of Colombia. So Colombia is basically controlling the relevant activities of Peru. Now, they have rights over decisions affecting the key revenue earning capabilities of Peru, including technological development, market to operate. The Colombia company has power of investee, and these rights enable to affect their return. That's why we can conclude that Colombia has control. Now, I'm asking one question from you guys. In my solution, one point I have missed. What is that point? Can anybody tell me? In my solution, one point which I discussed earlier, I missed here. What's that point? Let me see your presence. Excellent. Cost of investment, extra payment. Excellent consideration. And that's also a valid point which you guys should include. It's not here right now, but I discussed. As Colombia paid more consideration, so it's obvious Colombia will get more powers, or we call it control premium. So normally the parent company or the acquirer has the parent company or the acquirer gives the control premium, okay, to acquire the control. Okay. So this part is not, we can say it has come first time. Some of this thing has come before as well. If you actively do your past paper or exam kit, I don't think this is very challenging, to be very honest, because some questions of SBR are very, very challenging as compared to those questions. This is something normal or above average. Okay, call it above average, right? So now we are going to move towards the second requirement. But keep one thing in mind. One thing has been decided. Who's the parent? Who is parent now? Who is parent? Parent is Colombia. Who is parent? Parent is Colombia. And the NCI. Who is NCI? NCI is Brazil. NCI is Brazil. Okay. So for next requirement, we should keep this thing in mind. But to be very honest, they will ask only to calculate goodwill, nothing else. They will just ask us to compute goodwill, nothing else. So basic goodwill calculation, we need to do basic goodwill calculation. Okay. And one more thing, I again say this is model answer. If you write less than this, again, it's okay. I must say one thing to all audience. Even some position holders are also attending the class, those who took position in their last papers. Always go for maximization Never go for perfection. Write this line somewhere. You should go for maximization. That's it. Not for perfection. You cannot be perfect. Okay. So it happens, your answers and the exam kit answer does not match, or they write very professionally. It's okay. It's okay. Because they have the plan. They write through planning. At least three to four people write one answer. Some specialists write the header, then the conclusion, and the middle part they distribute it. And you guys go in the exam without knowing what is coming, what's the question. Okay. So just average performance you can do. Now next thing is Peru company's net assets. It's about, let me give you, it's about little bit of consolidation and a bit of IFRS 13. I always say in my lectures that IFRS 13 is a very key standard. Yes, it is a one or two class standard. It's a one class standard sometime, but yes, it comes normally because nowadays more than 20 accounting standards require fair value. More than 20 accounting standards require fair value. So for fair value calculation, IFRS 13 is there. Okay. So IFRS 13 is the heart of your course. You must know, all of you must know each and everything regarding IFRS 13. Better read extra articles for IFRS 13. Now let's start. The net assets of Peru company reported in the individual financial statement had a carrying amount of 32 million on 1st July X5. Yes, thank God. This is 1st July X5 is your acquisition date. 1st of July X5 is your acquisition date. 1st July X5 is your acquisition date. 1st July X5 is your acquisition date. Now, however, on acquisition of Peru, the directors of Colombia company discovered the following. Now, wait. If you want to calculate fair goodwill, correct goodwill, so you need to bring all assets, or I should say a better word, all net assets of S company at fair value. Okay. At reporting date, you need to bring all assets, or the better word, net assets to fair value at reporting date. Okay. Right. So they are saying already the carrying value of net asset is 32 million. Already the carrying value of net asset is 32 million, right? The carrying value of net asset is 32 million. But some adjustments are left. Okay, right? So let's don't jump into this part first. Let's write some previous things which we have already calculated. So our mind will be diverted from this. Okay. Now let me compute you COI first. Now, if you need to calculate goodwill, so for goodwill, first of all, you need to write the COI. So who is the parent now? Colombia is the parent. So just take 1 minute break. Wait 1 minute. Many students are asking about syllabus change. I have searched it properly. There are no material changes in the syllabus. Sometimes they write, they forcefully announce it that this is a change because it's the policy of ACCA and these bodies that after a few months, after a few years, they undergo a change. Okay, so but these changes are not material. Like whatever is coming in question number 1, it may come in question number 3 now. So these are not material change. Everything is same. And regarding the current issue is always available in the articles. And in this attempt, I have not seen any new article for current issue. So all those current issues which you guys were doing for last attempt, the same are here. So better watch all that management commentary thing, that integrated reporting, that Bitcoin thing, what we call it, cryptocurrency thing. These all are relevant. These all are again crypto. Yes, these all are relevant. Similarly, for that environmental reporting. Now, so we were on consideration, COI, cost of investment. So now parent company is Colombia is the parent company. So cash consideration, I just calculated for you, and that was 5 millions times half, 5 millions times half, 5 into 50%, that is 2.5 million, multiply by $8 per share. So this will make around 20 million. 20 million is the cash consideration. And what about shares consideration? Again, it's 5 times 50%, which is 2.5 million shares. And the deal is 1 upon 20, 1 upon 20, 1 upon 20, multiply by the per share market value of parent company's $10. So it's, I think, 1.25. So the total comes to be 21.25. Now the issue is this is COI, and the next thing is fair value of NCI at acquisition. Fair value of NCI at acquisition. Fair value of NCI, if we are using full goodwill method, then fair value of NCI at acquisition. So we all know that Brazil also paid the current prices right now, and that's the fair value. So how much Brazil paid? Same 20 million. Whatever cash consideration we paid, the same cash consideration is paid by Brazil. Okay, so it will be 5 times 50% into $8, which is, okay, so 21.25 plus 20 is 41.25. So this is the top section of your goodwill calculation. Now, the next thing is less fair value of net assets of S company. Less fair value of net assets of S company, right? So net assets as per question, I think it's 32 million. Net assets of S company, Piru company, as per question is 32 million. And now let's do some adjustment, plus or minus something. Let's do some fair value adjustments. Okay, so just read things actively. You will understand for sure. So the first item is on 1st January X5. Now see the dates. You guys don't read the dates carefully in the exam. Examiner write this in the feedback. Our takeover date is 1st July X5. The acquisition date is 1st July X5, but the story in the next paragraph is starting from 1st January X5, means 6 months before the acquisition date. 1st January X5 is the 6 months before the acquisition date. Okay, be careful. On 1st January X5, Peru company acquired 6 million 6% coupon bonds for 6 million in an unquoted company. That means acquired means purchased. So subsidiary company has invested in bonds, invested in loan notes or bonds. So when we are doing investment, then this is a financial asset. We are not on the other side. We are not issuing loan notes. We are buying loan notes. We are purchasing loan notes. We are investing in loan notes. So it's basically our financial asset. And you all know there are three categories. Listen to me. There are three categories of financial asset at debt. One is amortized cost, one is fair value through P&L, and one is fair value through OCI debt. Let's see what the category they are using. Bond interest is paid. See, this is your 1 mark or 0.5 mark. See, bond interest is paid annually. That means we acquired on 1st January X5. So the first interest we will receive physically on 31st December X5. The first interest we will receive physically on 31st December X5. That means, another meaning is, on 1st July X5, there is a 6 months accrued interest as well. There is a 6 months accrued interest as well. You're not getting. We invested on 1st January X5. And your takeover date is 1st July X5. So we need to calculate everything on takeover date. Okay. So at the date of takeover, 6 months have been passed. But the first interest will come on 31st December. So that means on 1st July, 6 months interest is accrued. So we must add accrued interest. In the carrying value. Of that asset. Okay. Now, due to a premium on redemption, the effective interest rate was 8%. Piru company has a business model. Now, Biru company has a business model to collect the contractual cash flows from the bonds, and therefore measures them at amortized cost. Okay, it's very simple. It's their wish. If they are fulfilling the condition, they can record it at amortized cost. Yes, it's fine. They can, if they meet both tests, business model test and contractual cash flow characteristic test, it's very good. If they are recording at amortized cost, no issue. But believe me, at the date of takeover, parent company will for sure record it at fair value. At the date of takeover, it is the responsibility of parent company to bring each and everything of S company to fair value. So that because of consolidation issue, we need to calculate the fair value, and I will calculate the fair value. Don't worry. Now, Columbia company holds similar unquoted, similar, not identical. It's similar. For those who have studied IFRS 13, for those who know the difference between identical and similar, so here the word similar is written. Similar, very good. Some students are replying me level 2. Excellent. Some students are replying me level 2 of IFRS 13. Excellent. Because similar means there are some differences which we need to adjust. So Columbia company holds similar unquoted assets, but has a business model whereby they may either collect the contractual cash flows or sell the asset. Mixed model. See, subsidiary company has the model of amortized cost, the long term, and parent company has the mixed model, hold plus sell. So parent company are recording at fair value through OCI. Now, bonds with again the word similar risk profile for a similar quoted company were trading at $2 per bond on 1st July X5. Thank God the ready-made fair value is given. Is given at the date of acquisition. See, now the date is 1st July X5. A discount of 30% is considered reasonable to reflect the difference in liquidity of the two types of bonds. Now, wait. Not difficult, and don't make it difficult, please. It's not difficult, and you don't try to make it difficult, please. One thing is what we call it carrying value. I will calculate it separately. The other thing, I will calculate the fair value. But that's very good, that they have given us a similar bond, similar, not identical, similar bond. Similar bond means level 2. Similar bond means with few differences, which we needs to adjust. So the fair value of one bond is $2 per bond. So how many bonds we have? We have 6 million bonds. Look at here. We have 6 million bonds. And the fair value of the similar bond is $2 per bond. So 6 million times $2 is equal to 12 million. But this is not the fair value. This is the fair value of the similar bonds. So, I always teach like this, that in level 2, you need to use your calculator. In level 2 of IFRS 13, you need to use your calculator. So the difference is how much? You need to discount it by 30%. You need to reduce it by 30%. So how you do it? When you want to reduce something by 30%, directly multiply by 70%. So my dear students, the fair value is here. 8.4 million is the fair value. You just calculated the fair value. You just calculated the fair value. You just calculated the fair value. No. One thing you guys are mixing up. Please don't mix it up. Just leave the parent company thing. Just leave the parent company can do any accounting, and that's their own books. Right now, we at the time of takeover, listen my words. At the time of takeover, we need to bring subsidiary company to fair value. We need to bring each and everything of subsidiary to fair values. Okay. So whatever we are doing, it's for subsidiary company. Whatever we are doing, it's for subsidiary company, not for parent company. Okay. So ignore the model of parent company. This, I would say, it's extra thing, right? So fair value is here. Fair value is here of the bonds. Now let's calculate the carrying value. The carrying value must include 6 months accrued interest as well. The carrying value must include 6 months accrued interest as well. The carrying value must include 6 months accrued interest as well. Okay, let me give you 1 minute to read it. Read it. Take your time. Take your decisions. One student is saying, I didn't understand accrued interest. I'm teaching you now with spoon feeding. Wait, sorry. Look at here. All of you, please look at the screen. This is 1st January X5, I think. And this is 31st December X5. You invested in the bonds here. And it is written, you will get the interest after annually in arrears. Annual means 12 months. So you will receive interest here. You will receive the full year interest here after how many months? 12 months. But your takeover date is 1st July. So that means at 1st July X5, 6 months interest you have earned, but you haven't received the cash. So this is accrued. So here 6 months interest is accrued. Here 6 months at the date of takeover. This is the date of takeover. 6 months interest is accrued. 6 months interest is accrued. Okay. Right. Now let me show you how to calculate the carrying value first, and the fair value of I've already taught you. Fair value of bond I've already taught you. Now listen. The first thing, because in the question, in the requirement, it was written to explain everything. So now I'm going to explain the COI part as well. In terms of the consideration paid by Columbia Company for the acquisition of Peru, the fair value of the cash paid will be equal to the face value. The cash has the same fair value. If you guys remember IFRS 3 business combination, look at me. If you guys remember IFRS 3 business combination says that all considerations, whatever consideration parent company is paying, must be recorded at fair value. Okay, so when you are paying cash, so cash has the same fair value what is written on the cash face. That's what they are saying. Columbia company has paid $8 per share for their 50% equity interest, resulting in the cash consideration of this. And you can also add also shares consideration is there. Shares consideration is there, which should be recorded using the market price of parent company, that is $10 per share. $10 per share. Okay. Then the second thing is NCI. NCI is also measured at fair value, and Brazil company paid $8 per share for 50% shares. So this will be fair value of NCI. So these are very simple things. Defining COI and fair value of NCI is simple. What you have done it, just write it. What you have done it, just write it. Nothing else. Now, Columbia company Columbia company has similar bonds where their business model is to either collect cash flows or sell. The bond should be measured at their acquisition date fair values, yes, and treated as fair value through OCI rather than amortized cost. When you have, listen, when you have at the date of takeover, you need to bring it to fair value. Remember, so it was already at amortized cost, but now definitely you will be shifting it to fair value. Now obviously you will be shifting it to fair value. The carrying amount of the bonds, now there is one dodge here. The carrying amount of the bonds in the individual financial statement of Peru company on 1st July X5 would be 6.24 million. Listen, 6 million was the original principal amount plus 6 upon, this is the accrued, 6 upon 12 of 6 millions times 8%. Can anybody answer? Can anybody of you answer? Listen, can anybody of you answer this thing? Why we are using 8%, not coupon rate? Why we are using 8%, not 6%? Can anybody please participate? Why we are using 8%, not the coupon rate? Yes, because in order to calculate interest expense or interest income, effective interest rate is used, not coupon rate. Effective interest rate effectively includes effects of everything. Okay. So for interest expense or interest income, interest expense or interest income, you need to use effective interest rate. So 6.254 million is the carrying value. 6.24 million is the carrying value at the date of acquisition. Now, can you tell me what is the fair value? Now, this is the fair value I've already discussed. As the bonds are an unquoted company and active market of identical bonds, identical is level 1. So there is no active market of identical bonds are available. So it's reasonable to use market price of similar. It's reasonable to use market price. It's reasonable to use market price of similar, that is level 2, adjusted with the differences in their liquidity. Now, how to calculate the fair value of bond? We have already 6 million bonds. Per bond is $2, multiplied by 70%, because 30% discount we need to adjust. So I think this was 8.4 million. Okay, so now tell me, this is the carrying value. Look at here, this 6.24 million is the carrying value of your asset. 6.24 million is the some students are doing one mistake. Listen, no physical interest has been paid by mid of the year. No physical interest, that is coupon, has been received or paid by it will be received at the end of the year. The physical interest will be received at the end of the year. Okay, so don't involve physical interest in this thing. Okay, now, So this is your fair value 8.54 and the carrying value is 6.24. So how much is the fair value adjustment, and is it upward or a downward? Come on, tell me, is it upward or downward, please? Yes, it's upward fair value adjustment. It's upward fair value adjustment. So there will be upward fair value adjustment of 8.4 less 6 point how much 24. Thank you. It's 1.2 point how much 2.1 something. 2.16 million. 2.16 million. Okay, so simply adjust this in the net assets packet. Simply adjust this is in the net assets packet. One question: as this is your financial asset, as this is your financial asset, when this is your financial asset, so asset is going up. Remember, this C is equal to A minus L. Asset is going up, so net asset will also go up. Asset is going up, so net asset will also go up. Asset is going up, so net asset will also go up. Net assets will also go up. Okay, so this 2.16 million will be added. This 2.16 million will be added. Let's do it. Fair value adjustment bond is 2.16. Fair value adjustment bond is 2.16 million. Fair value adjustment bond is 2.16 million. Okay, first thing is done. They are asking one question: why amortization table not used? Because yes, somebody, we don't need it, my dear student. We don't need to do irrelevant thing. Just 6 months thing. It's just a 6 months adjustment. So that's why no need to make all 4 columns and all. Also, we don't need PNL and SOFP extract. We just need to explain it. We read the requirements. Yes, I can show you the calculation of bonds. Somebody is asking again. Yes, please. This is the calculation. Yes, I'll share the PDF file. No need to copy it. I'll share everything. Don't worry about it. Now, next thing, please. Next thing, once again, go to the question. Next part is brand. It's pure IFRS 13. Pure IFRS 13. If you remember IFRS 13, we always, whenever we discuss IFRS 13, we see the perspective of market participant. We don't see entity-based factors. We see market. We promote market-based factors. We see the point of view of market participants. Hope you remember, right? Okay. And one thing, for non-financial assets, always go for highest and best use. For non-financial assets, always go for highest and best use, even if you are not using in that way. Still you need to calculate fair value using highest and best use. Okay. Now, one of the identifiable intangible asset of Peru company at acquisition date was a brand. The brand had a carrying amount of $4 million on 1st July X5. Colombia company has a similar branded. See, the carrying value is 4 million. Right now, the brand has a carrying value of 4 million. Now we need to calculate the fair value. I'm sure you guys can do it yourself. This is ordinary part. Colombia company has similar branded products and is therefore planning to discontinue the trade of Peru's branded product with immediate effect. Why? We are afraid that this brand will eat up our brand. this subsidiary company's brand is dangerous to our parent company's brand. So we are deciding, we means entity. So this is entity based factor. This is entity based factor. So don't see this what we are planning to do. See what market participants wants to do. See what market participants wants to do. Listen. The future cash flows from the Piru's product post acquisition are therefore considered to be nil. Okay, obviously because we are planning to discontinue. If the trade of the branded product were to be sold to a competitor in order to continue the trade, it is estimated that it could be sold for around 5 million. Yes, this is the fair value. This is the fair value. This is the fair value. Why? Because this is our personal opinion to discontinue. This is entity based factor. Normally in market a common man will continue it. It's a $5 million thing. People are ready to buy it for $5 million. So that means something is present in this brand. So the fair value of this brand should be $5 million according to market participants. According to the point of view of market participants, it should be $5 million. Okay, so four is the carrying value, 5 is the fair value. So 1 million is the upward fair value adjustment. Let me write it practically. Wait. Based factors also for non-financial assets, highest and best use must be considered. That's why the decision of Colombia to discontinue this brand is irrelevant in computing fair value of the brand. That's why from market participants' point of view, fair value of brand is $5 million. So very simple. These are very simple words, very ordinary words, no hi-fi words, no extraordinary words, simple words, and you can easily write it. Did you get it? Did you get it? Please tell me. Are you getting it? Okay. Now, the next thing is, okay, stay activated, please. So we have just posted this fair value adjustment. See, if you think C is equal to A minus L, asset is going up, so net asset will also go up. Asset is going up, so net asset should also go up. Net asset should also go up. Okay. Now, the last adjustment of this consolidation part, and then we'll be moving towards IAS 19. Then we'll be moving towards IAS 19. IAS 19. This part C. Peru companies has several technical support service contracts for which there are outstanding performance obligations on 1st July X5. That means go slow. This is apparently it looks like this is IFRS 15, but to be very honest, it's IFRS 13. It looks like it's IFRS 15. What is this? That we have some supporting we have to provide some contracts, and we have just received cash, but we haven't provided services. We have just received cash, and we have not yet provided the services. We have not yet provided the services. So this is sort of deferred income. This is sort of deferred income, or sometimes we call it unearned income. Sometimes we call it advance income. Okay. So it's your liability. This is your pure liability. Okay. So according to IFRS 3 business combination, at the date of acquisition, not only you need to bring assets to fair value, but also the liabilities should be bring to fair value. Also, the liabilities should be recorded at fair value. The liabilities should be recorded at fair value. Okay. So now let's see what is the carrying value first. First, see the carrying value. Included in the contract liability, deferred income, at this date is a balance of 2.8 million in respect of these contracts. 2.8 million in respect of these contracts. It is estimated that these contracts will cost 1.7 million for Piru company and any other market participants. See, now start thinking according to market participants. A markup of 30% is considered reasonable for this type of contract. Now, wait. See, carrying value is already given. Carrying value of the liability is already given. Now we need to calculate fair value. Now just use a market participant. A market participant is not a labor. A common man, market participant is a common man. Listen. So whenever we need to fix our things, whenever we need to fix our AC, we need to fix our tables, we normally don't do ourselves. We call somebody, we call carpenter, or we call mechanic, or we call the AC guy. And that guy obviously charges some profit. That's the market practice, to charge profit over cost. So in order to calculate fair value, you need to price up this cost. You need to add some profit in this cost. Then you will get the market value. So students, your cost is how much? Cost is 1.7 million, and this is markup. Markup means profit percentage on cost. So profit is 30%. 1.7 times 30% is how much? 5.4. 1.7 times, no, it's 5.1. It's 5.1 or 5.4. How much? 5.51, sorry. So if you add these two, 2.21, 1.7 plus 0.51 is how much? Yes. So 2.21 is the fair value of liability. This fair value of liability according to market participants. Okay. And what is the carrying value? 2.8 million. 2.8 million. So now you need to reduce the carrying value of liability. You need to reduce the carrying value of liability. You need to reduce the liability. Read it, please. As you all know, that this is C is equal to A minus L. Okay. Now, right now, this transaction is related to liability. So when you need to decrease, see, the carrying value is 2.8 and the fair value is 2.21. The carrying value is 2.8 and the fair value is 2.21. So you need to reduce the liability by 0.59. You need to do a downward fair value adjustment of liability by 0.59. So when liability goes down, see, net assets goes up. When liability goes down, net assets goes up. So again you need to add this 0.59 in the net assets packet. Again you need to add this 0.59 in the net assets packet. In the net assets packet, you need to add this 0.59. Okay, let me do it for you. Can anybody of you calculate the fair value of net assets? Can anybody? One question. How can we recognize this fair value? This whole topic is fair value adjustment. Why? Because at the date of takeover, they have told us that we need to adjust certain things, and this is a normal fact that all assets and liabilities at the date of acquisition must be brought to fair value. We know this thing. This is IFRS 3 business combination. So it's 35.75. Fair value of net asset is 35.75. So how much is the goodwill? Goodwill is 5.5. Thank you. Goodwill is 5.5. Okay. See this thing. See this thing. See this. This is the level of SBR. You guys spend almost a month in consolidation. Listen, you guys study step acquisition. You guys studies disposal. Listen, disposal, cash flows, consolidated cash flows. Wait, you guys studies foreign subsidiary and see nothing. It's all F7 level things. They have given you a different. It's a different style paper. And this is, yes, this is past paper. And this is not only past paper. This is the very latest past paper, the most updated past paper on the internet. So this is a taste of your examiner. Yes, anything can come up anytime. So you must have some knowledge of everything, some knowledge. So now please be active. Don't sleep, and don't run away. Don't sleep and don't run away. These are your ending days. So you and me as a teamwork, both parties should do some effort. Okay. Now the last part of this is IS 19, and that IS 19 is apparently it's a practical part. It's total practical, but yes, we need to write it in the form of theory. It looks like a practical thing, but we need to write it in the form of theory because in the requirement we see explained. Okay. But one thing I would request that you must know, all of you must know the 3-column accounting. The 3-column accounting of IS 19, you must know. I will try to do my max. I will try to give my 100%. I'll try to give my 100%, but still you must know at least some basics of IS 19. Otherwise, you will have problems. Okay. Okay. Now, this is the second part of this same question number 1. This is the second part of same question number 1. Now, no more consolidation in it. No more consolidation in it. Come on. Somebody's asking 5 years past paper is not enough, more than enough, too much. Now, Columbia Company has for many years operated a defined benefit pension scheme. In short, short one, defined benefit scheme. Who bears the risk? Who bears the risk in defined benefit? Who bears the employer? Yes, employer. So that's why we need to do detailed accounting for defined benefit. We need to do very detailed accounting for defined benefit. Okay. At 1st January X5, the fair value of the pension scheme assets were estimated to be 260 million. See, this is fair plan asset. This is the fair value of plan asset at the beginning of the year. And the present value of the pension liabilities were 200 million. See the hazard lights. Hazard lights are being operated. Why? Asset is more and liability is less. Those who know the standard, they can recognize in seconds, quick seconds. Asset is greater than liability. That means net plan asset is there. And 60 million is the net plan asset. So whenever you see net plan asset, you need to apply the limits of asset ceiling. And one thing you will find, the ready-made one thing you will find, and that is the present value of future refunds, and reduction in contributions, and that is C. The total of the present value of future refunds and reduction in future contribution was 20 million at 1st January X5. This is all about opening. This is all about opening. So I openly say this. Even this question is present in your study text as well. This question, a similar question, I have seen this. I have seen those who do study text of Kaplan. A similar question like this is present in Kaplan study text. I have forgot the name right now, but there is. So this year opening means last year closing. This year opening means last year closing. So whoever accountant solved this last year must apply the limits, So the net plan asset is 60 million and the present value of future refunds, that means the benefit is 20 million. So we all know we need to record it at the lower of these two. We need to record it at the lower of these two. So in the last year end, the accountant must have been reduced it to 20 million. So from this year, in the net column, there are three columns. There are three columns: DBO, plan asset, and the final column is net. In this year, the opening balance will start it from 20 million negative. From 20 million negative, okay? Because the accountant, whoever accountant solved it last year must have applied the asset ceiling limit. Do you understand this thing? Do you understand these things? Please reply. Chat box is in front of you. Obviously you must, if you have studied, you must know this in seconds. Now, so I will start the table with 20 million net. I'll start the table C. I'll start the table with 20 million net. Now you may ask, sir, these three columns, are we getting any marks for these three columns? No, we are not getting. Examiner has made this in their solution. But there is a note with this solution, with the three columns, that no extra marks will be given for this. No marks will be given for this. This is just for your understanding. And you all are used to with these three columns. That's why I'm following. And in the exam, you can do it in your paper pen. With the paper pen, you can do these three columns because the requirement is to explain. So opening net balance, I'll start with opening negative 20. I'll start with opening negative 20. Okay, right? Now, one more thing is very important. I'm not sure all of you, those who are taking the class, have studied my normal class, or you guys have studied from me or not. But the way I teach, I make three columns. The first column is DBO, second is plan asset, and third is net. There are some teachers, there are some trainers who make first plan asset column, then they make DBO column, and then net. So there may be a difference between their style and my style, but I follow this thing. Okay, so don't worry about it. If you are following that thing, that's also correct. But I follow this format: first DBO, then plan asset, and then net. Okay, and the major column is the net column. Now, as you have the net asset at the beginning of the year, this is not net liability, it's net asset. So you will have interest income. Please trust me. I know the rate, that is 5%. So 20 times 5% is 1 million. And interest income increases your plan asset. So right now in the net column, everything is going negative. In the net column, everything is going negative. So if it would be, just think, if it would be interest expense, it would have come with positive sign. But as it is interest income, so it will come with negative sign. Okay, so this is just simple. Now the next thing is, see this current service cost. The entry of current service cost. See the discount rate I have already incorporated. The 5% discount rate I have already incorporated. And now listen, attack the question with energy, with confidence. Okay, right? So the next thing is current service cost. What is the entry of current service cost? Let me tell you. Debit expense, debit P&L, credit DBO. Debit expense, credit DBO. So it increases your DBO. This is your current service cost, we sometimes write it CSC, current service cost. So it comes here 30, it comes here 30. Now you know how to make the net column, how to make the net column. First column less second column, DBO less plan asset. So 30 minus 0 is 30, 30 minus 0 is 30. So current service cost is here, current service cost is here. Please be confident. Now next, benefits, sorry, cash contributions, cash paid by employer, cash paid by employer, it increases your plan asset. And what is the double entry? The double entry is plan asset debit and cash credit, plan asset debit and cash credit. Now how much is this? It's 21. It's 21. Now wait, it's nothing is written here, it's 0, it's 0, 0 minus 21, 0 minus 21 is negative 21, negative 21, 0 minus 21, it's negative 21. Now wait, next thing is benefits paid. We all know benefits paid means obviously there are employees who are leaving the company as well. There are employees who are leaving the company as well. So we'll pay benefit, we'll be paying benefits through plan asset. So the entry is DBO debit. The entry is DBO debit and plan asset credit, DBO debit and plan asset credit. So it's very simple, 25 and 25, and the net effect is always nil. The benefits paid net effect is always going to be nil. Okay. Now one tricky, one not tricky, interesting thing. It's curtailment. See, this thing is these see these two. It's curtailment with settlement, curtailment with settlement, curtailment with settlement. This is curtailment with settlement. Okay. Now what is curtailment? Curtailment means changes in the plan. In short, changes in the plan. Or one more word, means reduction, significant reduction of employees from the plan. Significant reduction of employees from the plan. And I'm sure you remember there are two types of curtailment cases. The first is curtailment without, yes, this is funded. This is all funded plan. Listen, because we have plan asset. My innocent student, this is funded plan because we have plan asset is here. Now listen, there are two cases of curtailment. There are two cases of curtailment. One is curtailment without settlement, and the second is curtailment with settlement. Right now in front of you, the case is curtailment with settlement, curtailment with settlement. Okay. So what is the entry of curtailment with settlement? Look at me. Scheme curtailment, that means, listen, that means total, you just reduce your liability by 28 million because of curtailment. You just curtail, you just cut down your liability by 28 million. But as this is the case of curtailment with settlement, so definitely you need to pay something now. Wait, so how much you paid? You just paid 16 million. So I think it's gain. As a student, you may ask, sir, can you make the entry? Yes, very easy. My favorite entry. It's my favorite entry. Let me tell you. Listen, how much obligation was there? 28. So our DBO will go down, liability will be debited. Liability going down means liability debited by 28 million. And how much we paid through plan asset? It's 16 million. So we'll credit the plan asset by 16, and the difference always goes in P&L. The difference of this always, which is gain. I think how much? 12. 28 minus 16 is, yes, 12 million. So this is the entry. If you have taken any normal classes or any classes, I challenge you, you will find this entry in your lectures. Okay, so DBO debit, plan asset credit, and 12 is the income. 12 is the income. So now wait, let me post this entry for you guys. Listen, I'm writing here curtailment with settlement. So your liability is going down by 28, your asset is going down by 16. Now just use your brain. How we calculate the net column? How we calculate the net column? DBO, wait, DBO less, see, this is a minus sign, DBO less plan asset. So DBO is already negative, so it's negative 28, and then minus minus is plus, negative 28, then minus minus is plus. So negative 28 plus 16, negative 28 plus 16, it's negative 12. It's negative 12 here. It's negative 12 here. Use your brain, use your common sense. Okay. And now, relax, please. Sorry. I know I am without paper tension and you are with paper tension. There is a big difference. I can recall my days. Okay. But still the only thing you can do is work hard and then just enjoy your life. Please. You are with tension and I am without tension. I might watch movie after this class, but you can't. You can't. Listen. Yes, one question. In funded, yes, if it is a funded plan, then you pay from, if it is a funded plan, then you pay from plan asset. And if it is unfunded, then you put your hands in your pocket and you throw cash, right? Then you pay cash. So thank God it's funded. Right now it's funded. Now, the only thing, the last thing of practical, and then we'll simply discuss it. What at 31st December 05, that the year end, the fair value of the pension scheme assets were estimated to be 242 and the present value of liabilities is 195. Oh, again hazard light. At year end again, plan asset is higher than DBO. Now you have two options. Sorry, you can waste your time and you can do it quickly. The two options. I'll teach you from both approaches. I know both approaches, but I would recommend you to go quickly. Don't waste your time. Wait, what is your plan asset? 242 and 195 is the liability. 195 and the second is 242. I think it's 242. Yes. Can you calculate the year end? 195 minus 242. 195 minus 242 is how much? Please help. It's 47. Now, the first option is to waste your time. I know, I personally know this. I know well that there is, at the year end we should do asset ceiling adjustment. At the year end we must do asset ceiling adjustment. Okay, right now I have not done asset ceiling adjustment for year end, but I have to do. I know it. Don't worry. But let's solve the question without year end asset ceiling. You will get a remeasurement component here. Listen, how much? Please help me. Negative 21 and negative 21, it's negative 42. And then 12 is negative 54. Negative 54 and 30 is negative 24. So negative 24 and it's, I think, how much to write here? 24. This is the answer. Yes. So if you, yes, sorry. If you do it without year-end asset ceiling, you will have a remeasurement. You will have a remeasurement gain. You will have a remeasurement gain of how much? 24. You will have a remeasurement gain of 24. Okay, you will have a remeasurement gain of 24. It's 24. I'm just relying on you guys. Is this 24 correct? Some people are saying 23. What you are doing? Wait, let me. It's a 20. Yes, it's 23. Sorry. Somebody told me 23, 24. Okay, it's miscommunication. Leave it. Forgive me and forgive everybody. Now, so 23 is the remeasurement gain without solving asset ceiling. But you know the asset ceiling thing, the asset ceiling gain or loss also goes in OCI. Asset ceiling gain or loss, asset ceiling gain or loss also goes in OCI, and it's also part of remeasurement component. So why not do it directly? Wait, you know what's the, this is without asset ceiling. This solution is without asset ceiling at the year end. Now let me incorporate asset ceiling in 1 second. Look at here. The total of the present value of future refunds and reductions in future contributions, asset ceiling was how much? 25 million. 25 million. So just think, we always recorded at the asset at lower off. Listen, this is 47 and the second number is 25. Which one is lower? Out of 47 and 25, 25 is lower. So it's ideal to write directly. It's ideal to write directly 25 here. It's ideal to write 25 here, and now calculate the remeasurement component. Now calculate the remeasurement net component in seconds. Now calculate the remeasurement net component in seconds. Let me check. It's negative. Yes, it's -1. Sorry, it's -1. So it's remeasurement gain, the balancing figure of -1. This is how we do it. This is the best approach. So no need to do first without, no need to do in pieces. That first you solve it without asset ceiling, and then you take the effect of asset ceiling separately. Directly do it, directly incorporate the asset ceiling effect, and you will get the net, remeasurement component. You will get the net remeasurement component. Okay, you will be getting the net remeasurement component. You will be getting the net remeasurement component. Okay, first listen, please reply on chat box. Did you understand this whole thing? Okay, please don't sleep. Now, how to write it? Write whatever you know. For this requirement, I would say write whatever you know, just write it in simple words. Whatever you have done, just write it. You need to write the theory of what practical you have done. Okay, so first thing, let's plan it. You should discuss the asset ceiling thing. You know, whenever there is a net plan asset, yes, asset ceiling is recorded in OCI, obviously. That's why I'm saying that the asset ceiling gain or loss must be part of remeasurement component. Okay, so first of all, as asset ceiling is obvious in this question, so you should write about the asset ceiling. Then whenever you have net plan asset, you need to record it at lower of that net plan asset. And the second thing is present value of future refunds. That thing you need to discuss. Then you need to discuss about the interest income, then the current service costs, then the cash contributions, wait, then the benefits paid, wait. Then one thing which you should discuss is curtailment with settlement. And curtailment is the another name of amendment in plan. Curtailment is another name of amendment in plan, which is also called past service cost, which we also call it past service cost. And you know, the gains and losses of past service cost always goes in P&L. This thing you need to discuss. And you need to discuss as well at the year end, your net plan asset is, I think, 47, but you need to bring it down. To 25 million. So that will give you a net remeasurement gain, that will give you a net remeasurement gain of 1 million. That's all. That's all. That's the story. That's the whole story. That's the whole story. Okay. Now listen. IS 19 requires surplus. Surplus means net plan asset. Surplus means net plan asset. Surplus means net plan asset to be measured as the lower of C, to be measured at the lower of the surplus in the plan and the present value of economic benefits in the form of refunds from the plan or reduction in the future contribution known as asset ceiling. This is the general point. Yes, I wrote this general point because the topic was revolving around asset ceiling. The topic was revolving around asset ceiling. Okay. Now the next thing. At 1st January X5, 1st January X5 means beginning of the year, means ending of the last year. Surplus scheme amount to 60K. C, 260K was your plan asset and 200K was your present value of liability. So 60K was originally your plan asset, but yes, you need to apply the ceiling limit. You need to apply asset ceiling amounts to 20K, and therefore the DBA will be restricted to 20K. That's why I started the show. I started this question with negative 20K. I started the show with negative 20K. I started the show with negative 20K. I started the show with negative 20K, right? Now, interest on the pension asset, will amount to 1K, 20 times 5%, and will be credited to PNL. Yes, very simple. As this is interest income, not interest expense, so interest income will go in the PNL and on the credit side, not on the debit side, right? Okay, because of net plan asset. Next thing is cash contribution of 21K will be added to DBA. Even some students made the entry of cash contribution in the comment box. They made it. So what's the entry? DBA debit and cash credit. DBA debit and cash credit. Okay. And benefits paid of 25K will be deducted from both the scheme's assets and the scheme's liabilities. Benefits paid obviously are deducted from both sides, and that's why it creates nil effect to the net column. Then current service cost of 30K will be added to DBO and expense to PNL. So PNL debit and DBO credit, right? Now few things are left. That thing is curtailment with settlement. Let me write in front of you. Also, which means significant reduction of employees from the plan. It is also called past service cost, right? As this is the case of curtailment with settlement. That's why the cash will be paid out of plan asset because it's a funded plan, because it's a funded plan. So what will be the impact? The impact will be there will be a reduction of 28 million in DBO and 16 million in plan asset. Effect of P&L would be 12 million gain on curtailment. Okay, so this is if you want to make the entry, it's an extra thing. If you want to make the entry which I made for you, DBO debit, plan asset credit, and P&L credit. Yes, you can use the word DBO. You can use the word DBO, no issue. Okay, now what thing is left? The final at the year end. Listen, now the final thing. At the year end, there is a net plan asset of 47, I think 47 million. How? 242, I think 242 less, wait, 242 less 195, which means again we need to apply asset ceiling limits. Okay, so the present value of future refunds at 31st December X5 is equal to 25 million. That's why net plan asset should at the year end, wait, at 31st December X5 must be restricted to 25 million, which will give a net remeasurement, sorry, of 1 million, which should be reported in OCI. That's it. That's it. That's it. That's it. Sir, please tell me how we get to know about asset ceiling. Very simple. Whenever you see net plan asset, whenever you see net plan asset, you need to apply asset ceiling accounting. This is all about IS 19. one more free marks. One mark is free in this whole game. So yes, if the refunds is 50 million, so we'll record at 47. No change, no change. You can't go upward. You can't go upward. You record it at lower of. You record it at lower of. See, wait. This thing, we record it at lower of. Please check. Right? So one free marks is also there in IS 19. Can you guys tell me? Now the class is still continued. Please don't run away. These are ending days. Tell me, how many types of pension schemes you studied? One is defined benefit plan. What is the other one? The easiest one. One is defined, the other one is defined contribution plan. The other one is defined contribution plan. The other one is defined contribution plan. Okay. And this is that's the easiest. And you know, the biggest characteristic of defined contribution plan, the biggest characteristic of defined contribution plan is the risk is borne by employee. So it's not employer risk. It's not employer risk. So employer will sleep without taking any pills. Easy sleep. So whatever employer will pay, whatever employer will pay will directly go in. Now the contributions will directly go in the PNL. Now the contributions will directly go in the PNL. Okay. So just one paragraph which I missed. And now that it's time to walk through it. It's time to walk through it. Listen, Columbia Company, see this. Columbia Company intends all new employees to be offered a defined contribution rather than a defined benefit pension scheme. Okay. So now for this one mark, you need, to write just for first you need to write what is defined contribution plan of just one line, just half line, that in this pension scheme the risk belongs to employee. Okay. So contribution of 0.5 million were paid into defined contribution scheme for new employees over the last 3 months of the year. Tell me the treatment. Come on, all of you. It's not difficult. PNL debit and cash credit. PNL debit and cash credit. That's it. So you will write that this in defined contribution plan, contributions paid by employer will simply goes in PNL, So PNL debit and cash credit. That's it. No asset, no liability, no plan asset, no liability, nothing. Very simple accounting. Okay. So you guys can do it. Okay. So obviously they give you some easy marks. They even in this part there are many things are easy. This IS 19 is not that much technical. It's just, if you must have basic knowledge of asset ceiling, and the remaining all interest income, cash contributions are all basics. Okay. So now let's take a 5 minutes break. And then we'll continue with the next question. Let's take a 5-minute break, and then we'll solve 2 parts of the next question as well. Okay. So now we are moving towards question number 2. Okay. And in the question number 2, we are going to solve the IFRS part, the IFRS IS part of this question. Okay. IFRS and IS part of this question. Now let's start. Do expect, there are things which are technical. Do expect this first. Make your mind so that it won't hurt you more. Right now, Bismuth Company is a mining company. Investors in Bismuth Company receive earnings from mining projects as return on their investment. The year end is 31st December X7. The year end is 31st December X7. Important information, right? Now, the first thing is impairment testing of mines. Then that means this is IS 36 part. This part relates to IAS 36, IAS 36. Okay, so you have a lot of stuff, as IAS 36 is a small standard, so you have some ready-made stuff with you to write in the state the rule or general section. Okay, besides this practical thing, you have some stuff to write. Now what they are saying, at 31st December, Bismuth company owns mines which have a carrying amount of 200 million. The carrying amount of mines means it's your asset. The carrying amount of asset is 200 million. The company has committed itself to decommissioning, not a new word. You have been studying this since years. Decommissioning is, you studied in F7 FR paper. Okay, decommissioning liability, or sometime we call it compulsory disposal cost. Okay, so now the company has committed itself to decommissioning its mines at the end of their useful lives, 5 years or less. See, this is very important information. 5 years, that means the project itself is 5 years project. The project itself is a 5 years project. Why I highlighted this 5 years? There is one reason. If you remember the IS 36 lecture, look at me. In IS 36, look at here. When we calculate value in use, it is recommended to take next 5 years cash flows. It is recommended to take next 5 years cash flows present value. Remember? Okay, so now exactly they have used the word 5 years, so it's a good news. It's in line with standard. This thing is in line with accounting standard. Okay, now, and has created a decommissioning provision of 53 million. This is the value of your liability. Decommissioning provision. Provision is a liability of uncertain timings or amount. IS 37 says provision is a liability. So this is the carrying value of your liability. However, the directors are unsure how the decommissioning provision will impact the impairment testing of the mines. That's it. That's the heart of this question. You just need to tell them that how a liability should, because decommissioning provision is a liability, how a liability should be included in impairment testing. That's it. How a liability should be included in impairment testing. Don't use difficult word like decommissioning and this. No. Decommissioning provision is a liability. So the what directors wants to know, how a liability should be incorporated in impairment testing procedure. That's it. That's their question. I'll tell you how to do it. Okay, now liabilities cannot be impaired, but they are part of CGU, because we work like a CGU, whole cash generating unit. And in the cash generating unit, we have assets and liabilities both. It's a mixture. Now, at the end of the following information relates to decommissioning the mines at 31st December X7. Now these are the cash flow. The first thing is carrying amount of the liability. This is separate thing. This is the carrying amount of the liability, which we studied on the starting lines as well. Leave it. Now, whenever you need to do impairment, testing, you need to compute recoverable amount. You need to calculate recoverable amount. Recoverable amount is higher of two things. Number one is fair value less cost to sell, and number two is value in use. Number one is fair value less cost to sell, and number two is value in use. So listen, students, every time fair value less cost to sell is not given, and in this question it's not given totally, so ignore it. So we'll be going through VIU. Value in use. And what is that value in use? We calculate present value of future cash flows, present value of future cash inflows and outflows, present value of future cash inflows and outflows, Okay, now sale of reusable components, present value of future cash inflows from sale of reusable components. Definitely at the end of useful life, there are some components which are at their scrap value. We'll sell it, and this will be our inflow. Sale of mining output, yes, this is also your inflow. These two are your inflows. And operating cost from 31st December X7 to decommissioning date. That means obviously these are also future. See, operating cost from 31st December to decommissioning date. This is also future cash outflow. So 20 plus 203. 20 plus 203 is 223 is your inflow, and 48 is your outflow. 223 is your inflow, present value of inflow, and 48 is the outflow. But the good news is they have ready-made given you the present value. See the word present value. So you don't need to do discounting. These are already discounted amounts. These are already discounted amount. So if you want to calculate the carrying value, sorry, the VIU of CGU, VIU of CGU, it's 175. It's 175. Yes, correct. It's 175. Okay. Now, you read the question. What was the real issue with the directors? The directors, see these words. The directors are unsure. This line. The directors are unsure how the decommissioning provision will impact the impairment testing of mines. That's it. That's it. You just need to give answer of this. Listen. First, you will say, and you have seen this in your studies. Normally, when we work for impairment, we normally take assets. So yes, IS 36 allows, if there are liabilities which can be separated, it's better you separate the liabilities. You don't involve the liabilities, not in the carrying amount and also in the VIU, both, because the comparison should always be like with like. Listen, two things are compared. For impairment, two things are compared. The first thing is carrying amount of carrying value of CGU. The other thing is VIU of CGU. Remember? So if it is possible to separate the liabilities, to ignore the liabilities, so ignore the liabilities from both. But there are some liabilities which are part and parcel of the whole scenario. There are some liabilities which cannot be separated, like decommissioning liability. Decommissioning liability related to the whole project. Decommissioning liability is related to the whole project. You must know about this, right? So what to do with this decommissioning liability? Simple treatment. One line. You need to deduct from carrying value of CGU first. You need to deduct this 53 from carrying value of CGU, and then this 53 from value VIU of CGU. So that means you have taken the impact. Of this 53 on both sides, and now compare it. If carrying value is greater than recoverable amount, then there is an impairment. Otherwise, there is no impairment. That's it. This is the simple treatment. I repeat, listen again. If possible, and we have seen this also, if you can ignore, if there are some liabilities which are separable, then try to ignore those liabilities from both carrying value working and VIU working. Okay. But if there is a liability which cannot be separated, that means which is the part and parcel of the deal, then what you do, you subtract that liability from both workings. First you subtract it from carrying value, and then you subtract it from value in use. So the same effect comes on both sides. That's it. And then you compare it. The recoverable amount of CGU with carrying value, and you finally find it that is there any impairment or not? Okay. Now listen. Let me do the practical thing first. Okay. Listen. Let me tell you what was the carrying amount of mines. The carrying amount of mines was 200 million, and 53 was the carrying amount of decommissioning liability. Remember the question? So 200 minus 53 is, I think, 147. So the net carrying value of CGU is 147. The net carrying value of CGU is 147. Okay. Now let's calculate the recoverable amount. And obviously in CGU normally recoverable amount is calculated through VIU. So let's add or less present value of inflows and outflows. So first present value of inflow was 20 million, remember, and then 203, and then there was a present value of cash outflow of I think 48. So this makes 175. 175 is the present value of cash flows, net cash flows from this CGU. But as we have deducted 53 from the carrying amount, so to make the comparison like with like, we'll also deduct from here 53. Okay, so now we have VIU, or I must write net VIU of CGU is how much? 175 minus 53 makes, tell me the number. 175 minus 53, what's the number, please? 122. Okay, so what do you say? Should we book impairment? Its carrying amount is 147 and recoverable amount is 122. Shall we book impairment? Yes, we should book impairment. As how much is the impairment? How much is the impairment? 25. Very good. As, wait, let me write, as the net carrying value of CGU is greater than net VIU of CGU. That's why, what is the name of the company? What's the name of the company? That why Bismuth company must book impairment of 25 million and write the difference. 147 less how much? Okay, this is just the practical portion. And now I would recommend you no need to do this in Excel. You can do it in the Word. Today my software, I had some password issue with my software. Otherwise I would show you how this working on software. It's very easy. SBR software working is only typing. It's very simple. SBR software practice is very simple. Even for me personally, I can write faster. In the software as compared with the pen. My speed. Yes, is it okay? It's not okay. It's best. It's better you go with MS Word. It's best you go with MS Word. Even in my previous classes, it's on YouTube. I have recommended to do, yes, Goodwill also, everything. For Goodwill, you can make the table, everything you should solve the complete paper, because this is almost theory. This is 95% theory. So it's better don't change the screen. Solve everything on Microsoft Word, the word processing. Okay. No need to go for Excel and that, what we call it, Excel part or spreadsheet. Yes, no need to go for a spreadsheet, just word thing. Okay, and I personally solve questions on Word, all the questions. And even the examiner in the training session, sometime ACCA UK conduct is a teachers training session. In the teachers training session, they also recommend that this is your liberty, this is your choice. And even sometimes they say that it's about eating. You can eat with the spoon, you can eat with your hands, you can eat with chopsticks. The objective is to fill your stomach, tummy, right? Okay. So now what you need to write? Simple, simple, simple. Normally majority, see this, these are the theoretical. Normally majority of liabilities are ignored when computing recoverable amount in CGU, but some liabilities cannot be separated. Example, decommissioning liability, because it's part of deal. Because it's part of deal, it's part of deal. That's simply the introduction. That's simply the introduction. And now the directors asked you how to treat liabilities in the impairment working. Simple, whatever I told you I have written here. See, according to IS 36, carrying amount of recognized liability should be deducted from both carrying value of CGU and recoverable amount of CGU, computed through VIU approach. See, computed through VIU approach, not fair value, because when you call about fair value, when you say fair value of complete CGU, that means the person has already deducted liability. When you say fair value of CGU, that means whoever computes the fair value must have also taken the impact of liabilities already. So this is all about VIU, right? And these two should be matched. Now some general discussion. For impairment, this is also, this is even in my YouTube lectures. I have posted IS 36 in English language on YouTube as well. The for cash flow projections, you should take reasonable and supportable assumptions. The growth rate should be in declining rate. You remember all this lecture, the growth rate. You should take next 5 years. You should take next 5 years cash flows. Yes, you can take more than 5 years if your cash flows are very reasonable, if your cash flows are very reliable. Okay. Now, but if cash, yes, but if cash flows are reliable, then you can use more than 5 years as well. One more thing, you should also calculate the future cash flows using the current budgets, using the current and latest budgets, not very old budgets. Okay. So if you are doing budgeting since years, so you need to incorporate your experience. You need to incorporate your experience in VIU working, right? Okay. That's why latest budgets and latest forecast should be used. Latest forecast should be used for this VIU, right? So this is something, this is just a 5-mark question. This is just a 5-mark question. Still, this is too much. This is just a 5-mark question with some practical and some theory. So this should be more than enough. Yes, some people are asking, if you want to deduct the liability, the impact is same, but yes, still for the presentation purpose you need to do it. For the presentation purpose you need to do it, because this liability cannot be separated. Yes. Yes, one more question, sir. Do we still, this issue I the sir is, if we do we still get marks? So one student is asking, if the final answer is not correct. Yes, this is the real benefit of SBR, and we call it headroom. We call it headroom. And let me write this word. Headroom. There are different interpretations of this headroom. Headroom means, for example, this is a 5 marks question. See, the maximum marks are 5, but examiner will start checking this question with 7 marks. Examiner will start checking this question keeping in mind that we have 7 marks available. So if somebody has done 2 marks mistake, so 7 minus 2, still he'll get 5 marks. 7 minus 2, still he will get 5 marks. So that means headroom means relaxation in checking. Headroom means relaxation in checkings. It's a good news. So one interpretation of headroom is this. And you know the second interpretation which many UK trainers do. Even one of my friend is also teaching in Kaplan. He says headroom means, and it is written on the website as well, headroom means multiple solutions are accepted. Headroom means multiple solutions are accepted, because yes, it's a practical paper, that's why. So if your solution is wrong, even wrong, but you have given the logics, you have discussed why I'm saying this, so still you will get the marks. That means you know the approach, okay? So don't worry about it. For practical papers and the papers with real life things, they give such things. So the only thing you need is confidence. I always say the only thing you need is confidence. That's it. If you are confident on what you are working, you can do it. You can do it. And I just before this class, I was talking to one of few students. I said, this is natural thing. This fear is natural thing. It's everywhere. All you go any country and meet any student of SBR, they will say this. They will say this. Now we have one last question and then we'll end the class, and that is about financial instrument. That is about, this is not a short question, this is one part. One part. Now the second part. Now the second part of that same question, and this is about financial instrument and the especially financial liability. Listen, I'm sure you guys know about the definition, official definition of financial liability. What is the official definition of financial liability? In simple words, not more difficult words: contractual obligation to deliver cash or contractual obligation to deliver a financial asset is a financial liability. Repeat: contractual obligation to deliver cash or contractual obligation to deliver a financial asset is financial liability. That's it. That's it. If this thing is present in the contract, that you cannot avoid the cash payment, then this transaction is a liability. Otherwise you will classify it as equity. Okay, right? Let's start. Last, the good news is this is the last part. This is the last part, and then enjoy. Bismuth company has issued two classes of shares. We are the issuer of shares, class A and class B, in exchange for a cryptocurrency. Don't worry about this word, cryptocurrency, Bitcoin. Both types of shares permit the holders to vote and give an entitlement to rewards. The rewards here means dividends. For shares, whenever we invest in shares, the company gives us reward. This is the dividend. So they are talking about, with the name of rewards, they want to say dividends. Okay, so the voting right is there and the dividend right is there. So apparently it looks like ordinary shares, apparently it looks like equity, but still there are other characteristics which we need to check now. And yes, one more thing, this part is not more about the Bitcoin. This part is not more about the Bitcoin. It will be treated here as a cash equivalent. I'll tell you. Bismuth company has discretion. See, excellent line, the game changer line, game changer. Listen, Bismuth company has discretion over whether rewards are payable on class A and class B shares. Got it? That means you have no obligation to pay dividends. This is what happens with ordinary shares. So that means there is no contractual obligation to give dividends. Okay, this point is game changer point. In the end of this part, I'll discuss this as well. So right now, in these three lines, I should say this is equity. Okay, now one more line. Bitcoin can be readily converted into cash in Bismuth jurisdiction. Now this word, although if you go to accaglobal.com, look at me please. Although if you go to accglobal.com and if you read the articles, so Bitcoin and this cryptocurrency is normally treated as intangible assets. Cryptocurrency in normal circumstances, it is treated as intangible asset. But in this question, see, in this question, in the exam, examiner is the king. In the exam, examiner is the king. See what examiner is using, see the words of examiner. Bitcoin can be readily converted into cash. Hold, please. This is the last part, please, just for me. Did you ever read this word readily converted into cash? Have you ever read this word? Readily converted into cash. Yes, in F3 paper, in F7, it's type of cash equivalent. Yes, it's type of cash equivalent. Very good. Some students are very active. They are replying very good. They are giving very good response. So it's like cash equivalent, and cash equivalent is like cash. So you know what entry we should have made? We should make the entry cash debit and equity credit. If it is equity shares, if these shares are equity shares, so in simple, cash debit, because it's a cash equivalent thing. It's a cash equivalent thing. So you can debit cash and cash equivalent and credit equity if these shares are classified as equity. Okay, so this question is not about the Bitcoin, it's about the equity liability classification. The heart of this question is about equity liability classification, not Bitcoin thing. Okay, now let's just finalize two paragraphs are left, and then the class is end. Class A shares are redeemable are redeemable at par in the event of Bismuth company obtaining a listing on a formal stock exchange, which is highly probable. On listing, Bismuth company has a choice to the method of redemption, either cash to the value of 1 Bitcoin per 1000 class A shares, or shares to the value of 2 Bitcoins per 1000 class A shares. Note, 1 Bitcoin equates to approximately 12,000. Wait. A very abnormal, non-routine area here. You know, this redemption, which is almost a cash redemption, I will prove this will be a cash redemption, which is almost a cash redemption, is dependent on uncertain future. It's depending on a future event. So I'm sure you all know about, if you have studied the standard, you all know about this word, contingent settlement provision. Contingent Do you guys have ever studied I always teach in my lectures, in my routine classes, it is there. No, it's proper truth. In my routine classes, I taught this contingent settlement provision with full energy. Yes, it is there. And what is this in easy words? Contingent settlement provision is an equity contract, apparently is an equity contract with a what if scenario, with a contingency of cash payment. It's a normal equity contract with a contingency of cash payment. Means cash payment is dependent on one or more uncertain events. Cash payment is dependent on some contingent event, okay, which is not in the control of organization. So when this cash payment event is not in your control, so yes, you may need to pay cash. So there is a chance of cash payment. That's why standard is very strict. We all know about the liability. So that's why this contingent settlement provision should be booked as a liability. Now, wait. As a student, you say, sir, there are two redemption options. As a student, you say, sir, there are two redemption options. One is cash and other is shares. So if we give shares, so that means that's not a liability. If we give shares, fixed number of shares, then that means it's not a liability. I say, wait. Read the two options, and as As a rational decision maker, which option a normal person will go? Read the two options. Read the two options. Cash to the value of 1 Bitcoin and shares to the value of 2 Bitcoins. We are not stupid. We are very, very smart people. So the cash option is 50% and the share option is very expensive. So everybody will go for cash option. If redemption occurs, this is obvious that we'll pay cash. And if we are paying cash, then yes, there is a contractual obligation to deliver cash. Then there is a contractual obligation to deliver cash, and it's a financial liability. It's a financial liability. So option number 2 is useless, is worthless. Nobody will go for option number 2. Everybody will go for option number 1 because there is a big major difference. It's very cheap. So yes, the cash option is there. And when there is a cash payment option, the transaction is a liability. The transaction is a liability. I hope you got it. I hope you got it. I'm not discussing the second class, just first class, and hold now, hold, just read it. The question starting area, read it, and then I'll discuss the second area afterwards. Don't go far, don't run. Now wait, let me show you how you need to write this. Listen, this is the solution. According to IS 32, financial liability is a contractual, simple, basic definition. No obligation to deliver cash or another financial asset. This is the definition. Okay. Bismuth company has choice over whether to pay rewards on class A and class B shares. These rewards are like ordinary dividends. Yes, apparently these rewards are ordinary dividends because we have the choice, we have the option to give yes or no. Okay. Apparently, as there is no contractual obligation to deliver cash, that's why it should be classified as equity. This is the starting point of our discussion. This is the starting point of our discussion. Starting point of our discussion. That's why we are booking it as an equity. Okay, starting point of our discussion. Now, here Bitcoin is readily convertible into cash. That's why it should be treated as cash, or cash equivalent, okay, right? So if it is an equity transaction, make the entry cash debit, cash or cash equivalent debit and equity credit. If it is a liability, then cash debit and liability credit. Okay, now this is the answer of the first introductory area. Now let's discuss class A shares. Let's discuss class A shares first. See this. With class A shares, the case is contingent settlement provision because the liability is dependent on contingent. The liability, or you call it cash payment option. The liability, or you call it cash payment option, is dependent on contingent event, which is listing of shares, and it is highly likely. That's why class A shares must be classified as a liability. Why it is highly likely? It is written in the question that the listing is highly likely. And if we list, we redeem. If we are going to list, we are going to redeem these shares, and at the time of redemption, the cash option is attractive. The cash payment option is attractive for us because the value of settlement in the form of shares is double than cash. So it's obvious that Bismuth would go for cash option, that is 1 Bitcoin value in exchange of 1,000 shares. Okay, so that's why what you finally declared this transaction as a liability. You finally declared this transaction as a liability. Okay, only one class B shares are left now. Now listen, for the class B shares, this is the area. This is the area for class B. This is the area for class B. Listen. But before we start the class, this last paragraph, first one thing is very clear. The reward that is ordinary dividend, the reward which is ordinary dividend, it's your discretion. It's the entity's discretion. If you want to pay, you pay. You don't want to pay, don't, no need to pay. Okay, we read it. Bismuth company is not compelled. Bismuth company is not compelled to redeem the class B shares, but these shares do contain an option, only option. You know the difference between option and futures? You know, option means choice. You have right to reject it. Option means you have right to reject it. That's it. But these shares do contain an option allowing Bismuth company to repurchase them. Okay, right? So there is an option. There is an option after 2 years that you can repurchase. Again, repurchase means paying cash. But this is not a contractual obligation, dear. It is written option. So again, now we'll classify it as equity because we have the rights to defer it. We have the right to reject it. There is no contractual obligation. Financial liability comes when we have unavoidable contract to pay cash. Unavoidable contract to pay cash. Here this thing is avoidable. Option means it's avoidable. So for me it's equity till now. Now there is a dodge. However, if within 2 years Bismuth company fails to exercise its call option means right to purchase on the class B shares, then it must pay an additional, what the word? Reward to the holders of class B shares. Additional reward. What is the interpretation of additional reward? It means additional dividend. Wait, it means now whenever you are going to pay dividends to all shareholders, you will be paying something extra to B. You're not getting. For example, now if you have decided to pay $2 per share to all shareholders, that means you are going to pay $3 or $4 to them, but only in the event you decided to pay the dividend. Only in the event you decided to pay the dividend. And in the first paragraph we have studied that dividend paying, it's your option. So this line is also optional. This line, yes, increase, this line just means increase rate. Whenever you will be paying dividend, you will be paying on increase rate. So again, this last line is not your obligation. And when nothing is your obligation, when nothing is your obligation to pay cash, then this transaction is equity. Yes, class B shares are equity. Class B shares are equity. I repeat. First of all, in this second shares, they are non-redeemable shares. First of all, so no contractual obligation to deliver cash. And yes, there is a call option. Call option means you can buy back these shares, but again, that is option, choice. So you have the right to reject it. So there is no unavoidable contract to pay cash. So yes, it's pure equity. But again, this line hurts you. If Bismuth company fails to exercise its call option on the class B shares, then it must pay an additional reward. What does it mean? Normal reward plus something more. So additional reward is given when normal reward is given. When you give normal reward to all shareholders, then you will add something for them. And the normal reward is optional. In the starting, we have studied normal reward is optional. So until and unless you decide for normal reward, there will be no additional reward. So first, you will decide for normal reward. And whenever you decide the normal reward, the normal dividend, then you have to pay something extra to them. So again, this is not a liability. Again, this is not a contractual obligation. That's why this B option is equity. And now read the requirement. Please read the requirement. Discuss whether the class A and B shares should be classified as either equity or liability. I told you this question is not about the Bitcoin. This part is about IFRS. This part is about financial instrument. This part is about financial instrument, okay, right? So let's simply walk through walk through this last para. The call option of class B shares looks like redemption, but it's just an option, not mandatory. That's why this option does not create a liability classification. Also, it is written if Bismuth fails to exercise the call option, then additional reward or additional dividend is payable, which means this is the meaning, an increase in dividend rate, but the original reward is still at the discretion of Bismuth. That's why class B shares are equity shares. Okay, so first we'll decide for original reward, and then if we are giving original reward, then we'll give something extra to them. That's it. So this additional reward is no more an obligation for us. Okay, I hope you liked it, and please work hard now. Work hard smartly. Please don't waste your time on irrelevant things. Just do relevant stuff. Thus, just do relevant stuff. Somebody is saying this question was hard. Yes, SBR itself is hard. Otherwise, all junior staff, all clerks would become chartered accountants. So you will earn because you are different. You will earn because you are different. Okay, so I will update you about the next class. It will be on the coming week. I'll update you on the WhatsApp group. We just sent you the WhatsApp group link. So please be active and do attend the live class, the next live class. Okay, I'll try to solve this remaining latest past paper with you. Okay, so thank you, take care, Allah Hafiz, bye bye, take care.